Hello, everybody. Today is February the 26th, Wednesday. Welcome to our daily market recap or starting days. So, I know I've been having a little bit of mic issues the last couple of days. Um, it's just the fact that the software that I use and the microphone, the technical aspect is a little bit different than what I'm used to. So, I truly apologize for that. Hopefully, we can have that thing sorted out. So, the sound is a little bit louder and it's a little bit better today. Okay, so we're gonna start. I think I have to create a little bit of structure here. This is just doing it by the flow. I think I'm gonna start maybe around 8:45 and then go all the way up to 9:45 and just take a look at the first 15 minutes of the US equity open at 9:30. Again, I'm at Eastern Standard Time, so I'm here up in Toronto, and then I kind of tend to trade the Asia Open and the U.S. Open as well. So, without further ado, let's start. I First of all, we are TradeAway. We are a web trading platform. We created this web trading platform that connects to your MetaTrader 5. It is a platform that is designed to give you a better trading experience from strategy execution to risk management, order management, trade review. Our goal is to create a system that can be a virtual coach, something that will look at your trade history, something that will analyze your execution, your order management, your risk management, and sort of provide a feedback, right? So most of the education out there right now is just basically watch and learn and practice and no feedback and so forth. There's a little bit of mentorship, but we're here to change that model a little bit and add a little bit of automation in that process, right? We've basically broken the trading process into different parts: strategy execution. How do you do risk management and order management and so forth? So we've really broken that process down. Understandably, trading is a decision making process. Every time you're faced with certain facts, certain prices, certain charts, and that's when you have to make a decision, right? So we are here to create systems that will basically help you to make decisions, better decisions in trading. So let's start. We are again. This is my MetaTrader 5. I have my EA hooked up. So when I do that and I log into my TradeAway account and I just go refresh, then I'm connected to my terminal. This data is populating from the back end from my MetaTrader 5 and so forth. Okay. So the first part is going to be about market recap from yesterday. I understandably my microphone was very low and not a lot of people heard me. I know again I truly apologize for that. So let's just do a recap. And yesterday one of the things that I talked about was why was euro rallying yesterday, right? So if I look at the daily charts, yesterday there was a little bit of bump here. And one of the reasons why that is because the US 10-year Treasury notes or sorry, the U.S. 10-year U.S. Treasury yields were just hitting the lows of the year, and what that did was that created a bond yield spread. So basically, if you ever guys ever done a forward calculation of an exchange rate, the theoretical value of an exchange rate is basically based on the differentials in interest rates, right? This is just very fundamental. You guys don't need to know that. If you ever did a finance class, then they'll teach you about forwards and forward rates on a currency, and future rates on a currency and so forth. So basically, what's going on right now is that if you look at, I like to use Germany 10-year as a benchmark for European bonds. So if I look at, let's see where that is right here, DE10Y versus 10-year Treasury bonds. It's sort of hitting a little bit low. Obviously, this was yesterday. This was a big one yesterday, and today it's a lot lower. So what this is telling me is that the differential, the yield differential, the differentials between interest rates between Germany and US is starting to narrow, right? So US has been in the last I don't know 2 years has been it has been on a interest rate. The Federal Reserve has been on an interest rate hike, and that has led to the interest rate differentials between uh, the U.S. and Germany or the rest of the world. That has increased the gap, the spread between those between the rest of the world, and what that has done is that has made the U.S. dollar rally, right? So U.S. dollar in the last, let's see what over here. Yes, since 2021 has been strong because the Federal Reserve has been on a stronger rate hiking cycle versus rest of the world, and what that does is that just basically appreciates the US dollar. Anyways, these are just like fundamental things, just to understand, hey, why is US dollar so strong? Why has US dollar been so strong? So this is just of understanding of the fundamental reasons why price is moving in a certain way. Obviously, it doesn't move every day. That's not what the market focuses on. You see here that today the differentials, interest rate differentials has even narrowed a little bit more than yesterday, right? No, actually, this is a little late. So this is 2024. We don't have 2025 data. This is investing.com. I created a portfolio. It's also good for you guys to sort of create a portfolio and track the bonds and so forth, because I say this time and time over again is that currency market doesn't exist on its own. None of the financial markets they exist on its own. They exist within a within a financial system. So what happens in the bond market, what happens in the equity market, sorry, what happens in the bond market affects the equity market, and what happens in the equity market affects the currency market, because currencies are basically how do I put it? Currencies are basically a unit of measurement, right? So if somebody trades a Japanese bond, that's quoted in JPY. If somebody trades, U.S. bonds, that gets traded in U.S. dollar, and so forth with equities. So there are two aspects really to why currencies move. One is what I just talked about, is driven by financial markets, and the other one is driven by capital flow, right? So if there's a big investment coming into Australia or something, then that creates a demand for Australian dollar, and maybe the Australian dollar will appreciate, right? So I mean, you kind of sense that once in a while. I mean, it's very hard for us because to be particular and say this move was driven by so and so forth, because currency markets are $6 trillion market volume, a day. So you can't really tell, and we're just a little guys here as a retail trader. That's what we are. And the other thing that I always talk about is, unfortunately, as when you do, trading stocks or trading futures, which get traded in an exchange, say, you want to trade Walmart, that gets traded in S&P 500 because it's a consumer product, um, and S&P 500 gets over to the New York Stock Exchange, and they're the ones that are clearing the trades. That's where the centralized location is happening for buying and selling. So the New York Stock Exchange, they have all the record for who's buying, who's selling, and even the order flow and the order book and so forth. With currency markets, we don't really get that, because the currency market is a very decentralized system, meaning that banks are trading with each other through via an electronic communication network or a fixed trading and so forth, right? And the biggest banks that do a lot of the currency trading is Citibank, Barclays, and JP Morgan. They handle most of the currency trading volume. So as retail traders, which makes like less than a couple of percent, I don't know what the number is, maybe less than 5% of the volume. We don't really move the market. Our job, to be profitable in this business is to make sure that we look at the footprints of what the big banks are doing, and the way you do that is just looking at the trend. And what we do is We make calculated decisions based on what we see in the chart and what we see in the data, right? So that's what we do. And in TradeAway, we focus on executing an intraday trading system, meaning that we don't hold trades for the rest of the day. Our trading strategy is basically, we look at the daily intraday trends. We identify which currency is stronger, which currency is weaker. We do visual confirmation of that on the charts, and based on that, we make trades. And when we make the trades, we manage our risk. We do order or active buy sell trade management, meaning, within the risk management framework, we have within the risk management framework, we have strategies where you can minimize your risk on your open trade and so forth. The whole idea is that, sorry, my computer just froze a little bit. So the whole idea is to minimize your risk and maximize your return, not just in terms of before you open the trade, but also while you are in trade, right? So having said that, let's move into the market. Let's do a recap of what happened yesterday. So basically, yesterday, one of the biggest numbers, the thing that shocked the market was that the CB Consumer Index came out. I covered this yesterday before it actually happened, and I was talking about how this would be the market moving number, because if you look at the S&P 500, right now, what's going on is on Friday we had on Friday on Friday, what happened was the Michigan consumer sentiment number came out, and there are about, I don't know, five parts in the report. There's each part measures how the consumer is feeling about the economy. There are two types of economic indicators, or the economic data that comes out. The first type is basically uh, sorry, I'm just gonna give me a quick second. I'm just gonna see. My computer seems like it's freezing a little bit. Okay, so there are two types of economic data. One is a what you call a lagging indicator, lagging economic data. So this can be anything from retail sales to stuff that home sales price and so forth, and even employment numbers are also considered to be um, a lagging economic data, right? Because it's basically measuring, what happened, what was the data for a month ago, but it's not telling you, what do the consumers think, right? Or what is the data, or what you call a forward-looking data, right? How are the businesses feeling about the business economy? Please do excuse me. I have a little bit of a cough. So basically, what the leading indicators does is that it measures the sentiments of businesses, consumers, how are they feeling. So that sort of gives you a feedback on, what is the consumer spending going to be like, right? How do consumers feel about the employment or looking for a job, right? So that kind of stuff, it translates back to into their spending habits and so forth. And financial market is a forward-looking system. So financial market is where they say investors are. What they do is the investors, they form the outlook for the future, and based on that they make economic decisions, right? That's just what it is. So anyways, circling back to our CB Michigan consumer sentiment that came out on Friday. So basically, what that did was that what that said, or what that entailed, the report entailed, was that the consumers are not too happy, right? So the stock market so far, the equity market so far, has been buy the dip mentality, right? Mr. Donald Trump has been the president, and he's going to cut taxes, and he's going to make regulations. He's going to lax these regulations on businesses, and that is going to drive up capital spending, and that's going to re invigorate or revive the economy, and the economy is going to get hot and so forth, right? So that's what I think what has been sort of like the thinking in the equity market. But what's actually happening is the opposite, right? So we are, we're dealing with inflation, and there are lots of federal um, jobs being cut, and that also doesn't mean just the federal jobs, but it also means that the contracts, right? There are a lot of contracts that happen. It's a multi-billion-dollar industry where they get contracts, and all these contracts are disappearing and so forth. And that, I think, is sort of it's slowly showing up in the consumer data. Consumer, like on same thing. So there are two types of consumer of leading indicators that are out there. I don't know if there are more, but there's the Michigan Consumer Index. So what they do is they basically go out and do surveys, and they say, well, how do you feel about the economy? How do you feel about your job? How do you feel about inflation? Are you going to go out and make a big purchase, and so forth? So um, like I was saying, that's been buy the dip mentality. So, when the numbers came out on Friday, that was a big shocker, because I think five elements of the report, which has never happened before, they were all down, right? So this is the first time, maybe the elements in the report is inflation and jobs and so forth. They were all down, and the report wasn't pretty at all. I mean, traditionally, you don't have Michigan consumer sentiment number come out and really move the market, but this time it did, because it actually showed you that, okay, well, the consumers are not doing too well. So that happened on Friday, and the market just sold off, right? And the other thing that I was talking about yesterday was, how does that translate to the currency market, right? So, like I was saying, currency market doesn't exist on its own. And how does, something that is happening within the equity market, if it's, having a um, big fall, or a big sell-off happening, and how does that reflect in the currency market? So basically, in the currency market, you have about eight currency pairs, right? So you have Euro, USD, AUD, GBP, NZD, CAD, CHF, and JPY. So if I were to bucket these currency pairs into correlation, so I would have Euro, GBP, CHF. These are the European currencies. And then I would have Australian dollar, Canadian dollar, and New Zealand dollar. Those are the commodity currencies. So Australian dollar is heavily relying on commodities like coal, and I think there's, I know, some other stuff as well, but I think coal is one of their biggest. Gas, natural gas as well, and so forth. New Zealand dollar is reliant on dairy export, fruits and vegetables and meat. And the Canadian dollar is relying, their main economy export is the oil, the sour heavy crude oil that they sell to the U.S. So if the um, suddenly the investors, global investors, their sentiment on the outlook for the global economy changes. Suddenly we're saying, hey, you know what? The consumers are not doing too well. Maybe they're going to scale back on purchases, and that's what, it's going to lead to a loss in momentum of the economic growth. Then you're going to have, they're not going to be, most likely there's not going to be a lot of demand for commodity goods, right? And that sort of, it seeps in through the commodity currency. So when you have moments where it's risk on, so what do I mean by risk on? You'll hear a lot if you watch TV. They'll say, commentator will come on and say, oh, it's a risk on day, it's a risk off day. So it's very important that you understand what a risk on day and a risk off day is. So basically, what a risk on day means is that the global investors, they're feeling very positive about the global economy. So the money is chasing high yielding assets, right? So stock is a high yielding asset. You have cryptos, or sorry, not cryptos, maybe cryptos, I don't know. So you have stocks, equities, you have commodities, you have like, corporate bonds. These are the asset classes that kind of tend to do better, right? So the people are saying, okay, well, it looks like the outlook is positive, hence we're going to go out and, we're going to chase a little bit more returns. And when somebody says it's a risk off day, like, this was a risk off day, right? So basically there's a little bit of what do you say, fear in the market. So basically, if you look at anything, there's called, the market is based on fear and greed index, right? So it's what's happening today. Is it fear, or is it greed, or is it in the middle? So when there's a little bit of fear in the market, what happens is that equity goes down. So mostly the risky assets, equities, corporate bonds, commodities, they tend to do poorly, right? So continuing our discussion. So basically, how does that reflect into the currency market? So, like I was saying, we have certain currencies that do better, they perform better. So you have U.S. dollar and JPY that actually does a lot better when the risk is on. So you'll see AUD, NZD, CAD, they perform poorly against USD and JPY. The actual thinking is that, especially with JPY, they've had a very long period of low interest rate. So if you once in a while, maybe in currency trading, you'll come across a term called funding currency. So what this does is, you know, JPY is the world's lowest interest rate right now. So investors, what they do is they will borrow money from in JPY and pay little interest rates, and they will use that money to invest in higher yielding asset. So higher yielding asset means, obviously it's assets that are a little bit risky, but with risk comes a higher return, so it will chase that, right? So when you have a risk off day, like yesterday or on Friday, what happens is a lot of those trades, they are reversing, right? So, they're reversing. Hey, I don't want to be in risky assets anymore. There's a little bit of risk. It's a risk off day. And what happens is that's the time when, the yen starts to rally. So, I mean, obviously, this is happening really fast. Algorithms are doing it. Humans don't trade anymore. I think I was watching a video on, who was it? Citadel. Citadel is they have two parts. They have a hedge fund part, and then the other part that they have is a clearing business, right? So they're the ones that are matching trades. There's a buyer, there's a seller. It comes through New York Stock Exchange, and there used to be a clearing house to match the buyer and seller. And Citadel just happens to be one of them. So they reroute their trades to buyers and sellers, and all this is done by algorithm. So before, maybe they'll have, maybe in the 70s, 60s, maybe they'll have like some level of, mechanical human being there, but not anymore. So, anyways, that's the thing about risk on and risk off. And yesterday with the CB Consumer Price Index number that came out, this is the number that came out, and it wasn't pretty as well. It's been the lowest since 2021, I think. So it has had three monthly declines in a row, and that kind of spooked up the market a little bit, and you had a big sell-off right here. But then by like 11 o'clock, the market kind of bounced back, and this, I think, would have been a sort of like over here. I mean, it would almost form a doji candle. So if I look here, well, I mean a pin bar. That's what I meant. A small pin. It would form a pin bar, and that's what happened. One interesting thing is gold, right? I was looking at some I was looking at some discussions on, what's happening to gold, right? What's happening? It was a sudden sell-off. Like, what's going on? There's a lot of people asking that question. So, like with gold, there's the demand and supply, and I was reading a report on how the gold demand is driven by like investors wanting to move away from the U.S. dollar because here we are. The U.S. policy is to slap tariff on everybody and change the global world order and side with the Russians and so forth. So that's one. And then the other thing is that it's the Chinese central banks, trying to diversify their foreign exchange holdings into gold. And then it's also the Chinese consumers that are also investing in gold because China right now is economically is not really doing too well because they've had a property bubble. Nobody's buying property. They're in a very deflationary mode right now. So I was reading a report that it's the Chinese consumers or people that are buying gold as an investment. Obviously, that's not gonna be the only factor that's driving it. So traditionally, when it comes to risk on and risk off, gold is a little bit different because when this consumer report came out, gold sort of like, sorry, it wasn't there. It was right here, I think. Right here. Okay. So it was right here on the 21st, 21st, 21st. Yeah, okay, so Friday, right over here around this time, the gold report came out, and gold sort of sold off initially, and it rallied. That was interesting because normally what happens is like, so that happened. Okay, let's stick to that. And then yesterday, when the market sold off, there was a bigger sell-off in gold. And then after 11 o'clock, when the market stabilized and it tried to rally back on, gold also rallied, but it didn't rally as much. So if you look at the past history of gold, one thing that you'll realize is that, and this is just based on what I've read, is that when there's like significant sell-off in equity market, what that does is like you'll have positions, hedge fund positions, you have over leveraged positions, you have like all these different institutional positions. Excuse me. So you'll have a lot of these institutional positions that are blowing up, right? So they're making margin calls, they're heavily leveraged positions, like we don't know, right? Because the way financial market works is that one event will trigger multiple events, and suddenly you'll see it. There's this thing called, I don't know if you've heard it. They call this thing called fat finger. So somebody puts in, they're meant to put in like certain, like 1,000 order, or I'm obviously 1 million order or something, and they put in like 1 billion. They add like a couple of extra zeros, and then thing just blows up, right? I think that happened, I don't remember, like 2015, 2016, when there was a dollar crash, and there was a stock market crash. I think that was the last one that happened. Anyways, the point is that a thing about gold is that when an event like that happens, investors, what they tend to do is they tend to sell their profitable position. Obviously, gold has rallied. It's a very profitable position that they're in, so they're going to liquidate that position, and and then make margin, right? So you'll see that during the COVID times, gold was significantly sold off. Similar thing. Or was COVID? COVID, right here. So February, I remember February was, January, December was when people started talking about stuff that's happening in China, and then COVID, China, and then February 19th, 20th was when, there we go, 24th, it was making this one, and this is when the stock market really blew up, and equity markets were down, and what happened was that I'm pretty sure a lot of hedge funds, leverage funds, and all that stuff, they had to sell their gold holdings to to meet margin on their other position, and that what that does is gold significantly sells off. So did that happen yesterday? I'm not sure, right? Um, so but definitely the price action is there. And again, like I said, without knowing, having order books or order flow, it's impossible to tell. We can just make a guess. The other thing about gold is also that I was reading a report with JP Morgan. They're saying that, the yearly target that they have on gold is 3,100 or so. Anyways, that's fluid. Things will change. Financial markets are dynamic, right? There's constantly where what we're doing is basically trying to predict the future, and based on that, well, the future of the economic conditions of the future, and based on that, everybody's making their decisions, they're making the investor decisions right now. Okay, so that's the thing about gold. So let's circle back to um, the currencies, all right? Because we'll just focus on currencies. Um, so that's what happened yesterday. Let's take a look. So euro was pretty strong yesterday. This because of and then because of the fact that now the market is starting to price that, hey, consumers are not doing too well. Federal Reserve said they're going to maybe do one rate cut and hold for a bit. So now what the market is starting to price is that the Federal Reserve has to do more cuts, right? We have to do more cuts, and I'm going to put CME Fed Watch. So this is a very, very useful tool. I highly recommend thing. So this is from the CME group. You'll see somewhere in investing.com as well. So now let's look at this is basically, so you have March. So basically in the March meeting, there's what is the market really pricing in, right? So the market is pricing in that in March there's a 95%, 75, sorry, 97, 98% chance that it's going to be in current. So you move out down the line. This is basically called the curve. So you move down the line and you see May, it's the same. Let's see if anything changed. So this is the current one, and then where is the price going to thing, and then you see here. Okay, so you see here February 25th. Well, I mean, sorry, I should be looking at the 2019th, right? So we'll do a comparison between 19th. So now you look at the February 19th. February 19th, market is pricing in 12% chance that, there's going to be a Fed rate cut in May, right? And now, as of yesterday, the market is saying that there's going to be 25% chance. So it really moved up from 12 to 25% chance that the Fed will have to decrease the interest rates in their May meeting, right? And that's one of the reasons why the bond is, doing poorly. Deal, and that is one of the reasons why the market started pricing in the Fed rate cut, and that is leading to the U.S. dollar appreciating, right? That's what it is. So I highly recommend this. This is very interesting. If you want to understand the real dynamics of interest rates and all that stuff. So now let's look at maybe we'll just continue with this. Let's look at these probabilities. Now let's see. Okay, this is very interesting because before the market was saying there was 5.2% chance of Federal Reserve doing 2 rate cuts. Right now, that market is now pricing that it's it triples, a 15% chance that the Federal Reserve will have to do 2 rate cuts. Right, so this is where we are: 1 rate cut, 25 basis rate cut, another 50 basis point. So as the economic data comes out and so forth, this is very dynamic. It changes, and when this changes, the currency market changes as well, right? So that has been the fundamental drivers of the currency market. So next, we'll just focus on our intraday trading strategy. I went over this yesterday in our daily call, but my microphone was really poor and I having some technical issues, so it didn't really work too well. So I'm gonna go over it again. Okay. All right. So we talked about first off, and before I start, I should say that this strategy is based on pure price action. I know there's a lot of ICT guys looking, drawing and doing words and all that stuff. I've known Michael Hutcherson, I think, since his early days at forexfactory.com. Believe it or not, Michael is I think he's from Baltimore, Maryland. I followed him. So, at the beginning of his days, 2013, 2014, he came out and, he came out with, like a process where you can, it's easier to understand the concepts that I just talked about, right? The yield differential concept. And he sort of came up with that concept and for to make it easier to understand, very simple terms and all that stuff. But there's so much noise in ICT, and everybody's layering and layering. It's like it just becomes a cake, right? Layer, 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 layer. Everybody adds their interpretation. That I think that the way Michael really meant it to be has been lost in the messaging, right? So I have nothing against ICT, honestly. It's great. You can I know people that are they look at astronomy and they predict the stock market. Why not? Because us as a human, we're driven by something, right? There are certain things that happen on high tides, the moon and all that stuff. It affects us. There's always the somebody's called sundowning, like syndrome. All that stuff affects us, and when that affects us, it also affects our decision making and so forth. And I know people who do that, right? Okay. Well, let's circle back again to our strategy. Let's not be too sidetracked. Um, so our strategy is basically using a candlestick. Candlesticks. We look at the daily, intraday, a daily trend, and based on that, we make a decision. Based on that, we trade. So you're basically we use heat map. We use the heat map to identify which is the strongest currency and which is the weakest currency, and based on that, we'll make our um, you know trading decisions. Right. The goal here is basically to identify which is strong, which is the strongest, and trade it against the weakest. That's just basically the thing. I know that there are some that will say, okay, well, just focus on one currency pair, and then and just understand the resistance level, understand the price, and so forth, and based on that, just trade one currency. But I say, well, that doesn't make sense because if you're gonna be a trader, then you make money when the prices are moving, right? So you'll have a day where let's look at a very so you'll have a day where it's something like this, right? So, well, obviously no GBP is strong today. So you'll have something like this, right? This is a very noisy chart. So you're trying to trade this. This is very difficult to trade because there's not a lot of momentum up, and it sort of reverses. And you're if you only focus on trading euro CHF, then you'll get stuck because you're just trying to make a trade, and you're gonna force yourself. You're gonna corner yourself into making a trade, and that's just poor because this market is not really moving. So when it comes to currency pair, we're just gonna be able to trade anything. I mean, understandably, one of the reasons why people say, you'll hear this advice of trading just one currency pair is that it's harder to do with position sizing, right? But when it comes to trade away, we actually doesn't matter what you trade. You say, okay, well, I want to trade oil. Oil is crashing and so forth, and then you just there's an oil report coming out today, every Tuesday. I think it's today, isn't it? Yeah, this one right here. This is something that will move the oil market. This is just a data that comes out of the EIA stockpile numbers. I think it's a Christian, Texas, Oklahoma. I don't know where it is. Anyways, basically what they do is they go out and measure, like, the stockpiles of the oil, and that basically just dictates, how um, much oil is being used, and that drives the oil prices. That moves the oil prices. So what I meant to say is, like, when it comes to trading assets, the most important thing that you really have to understand is position sizing. And it's hard to um, uh, um, do these manually because it's based on different settlement currency, or margin currency, and all that stuff. So here at TradeAway, again, what I'm trying to say is that it doesn't matter whatever currency pair you trade. The position sizing is automatically done for you, so you don't really have to uh, like make a guess. So, and you also see your trade parameters right before you you know right before you make the trade. So it's a little bit more easier. You see your margin, you see your profit, you see your loss, you see your RR ratio. So you say, okay, well, I want to do 1, 2, 3 RR ratio, and here we are. You can just do this trade, and then it'll come in, right? For example, let's just do this. This is just hooked up to demo account, FTMO demo account. We test a lot on the FTMO, prop from price feeds, right? We look at their prices, and we do a lot of testing on their price feeds. So let's just do this, right? So this is just an example, and I will do take profit one over here, and then I'll place it, and bam, it's done. You'll see my expected profit was 12.5 when I originally did it, right? Right now is, there's a little bit of rounding error, obviously. But yeah, this is what you do. Now your expected loss, if this trade hits, is 62.82. Your expected profit, if should it, your expected profit here is where expected profit is also taking your TP1 into consideration. So if I were to remove this, and your expected profit should also change. Right, so now it changed to 50 instead of 0.38. I'm going to get into that risk management strategy later, but just doing a quick rundown on. So now I'm just going to close the trade, and trade's done. So circling back to the currency markets. So like I was saying, is that a lot of you'll hear a lot of advice on just focusing on one currency pair, and technically you should just focus on one asset class, which is the currencies, right? So you should be able to trade any currencies with a tool like TradeAway. So let's do a rundown on what's what and what's happening so far, and our strategy as well. So like I was saying, we use the heat map as an indicator on the strength of a currency. So we're also modifying this. So as it stands right now, we are basically this measures the strength of the currency pair throughout the day or one day. We want to change that. We want to change that into sessions, because our strategy is based on the session time theory, and I'm going to get into that in a bit. So basically what the session time theory is saying is that we have 4 sessions. We have Asia, we have London, we have New York, and then we have something like the close session, right? So something that will happen around from like 1 o'clock to all the way to 5. That's when the market is, you don't really see a whole lot of action then. So that's the time when, the market sort of tails off, right? So coming back to this, so you have 3 sessions, you have 4 sessions. The market, so you have the Forex market session, and then you have the other thing, what we called is the daily average range. What's it called? Daily range theory, right? So basically, what the daily range theory tells us is that currency markets, on most of their times, they tend to have like a daily range, right? So if I go over here, This is like a box plot tool that we developed. So what this box plot tool is saying is that if I look at my n equals to 90, if I look at my 90 days data, and if I take my current lows of the day, um, my expected daily highs is around this right here, right? Oops. So it's like around here. Oh, why am I? That's not working. So it's around this right here. So this is my expected daily range. Obviously, it's not going to happen all the time, but this is saying that if I look at my 50% of my data, my expected daily range is supposed to be from Q1 to Q3. This is called a box plot with thing. And if I were to look at the daily highs right now, my expected daily range is supposed to be here, right? So given the daily high, my expected daily range is over here. So let's look at odd today is a little bit there's strength in it, so I'm going to get that in a bit. But let's look at something else. Let's look at Euro CHF, right? We'll look at Euro CHF. This is a very it has like small range. So this is basically saying that it's the minimum part, the minimum range is this. So most likely it will hit this. So that's what a box plot does. It gives you an idea because at the end of the day, the whole I guess the whole backbone of this theory is that this is G7 currencies, right? So G7 currencies, they have a lot of trade that's going on, global trade that's relying on the exchange value of the currency, and obviously the central banks are not going to let the currencies appreciate by like 5% one day and then another 5% down. Like I'm just giving you an example. Obviously this is not 5%, but the whole point is that they're not going to have they're not going to let a lot of volatility go in, like 5% one day and 5% another day. They're not going to let it trade like an emerging market currency, right? Because that causes a lot of friction in the global trade, and that's not a good thing. And sometimes when that happens, the central banks, they will like just come together and they will like support the currency. Like this actually happened in the European debt crisis, right? So euro was falling so fast and so hard that the Federal Reserve had to team up with the European Central Bank to stabilize the currency. It actually happens. And that was times when Mario Draghi came out and he said he's going to do whatever he can to stop the depreciation of the currency or stem the financial crisis. Anyways, so you have that. We talked about the session time theory, and then we talked about the daily range theory, right? So you have that, and the markets are going to open in 2 minutes. So basically, this is that. So the way we use this tool is to understand, the ranges, right? So if I'm here and I want to make a high, then good thing would be to target around this range, right? If the price is already here, given that there is not a lot of volatility or there's not a lot of thing in the market, stuff happening in the market, then I would expect the price to really just be around here, and you'll see this time over again, especially in the Australian US dollar. US dollar is strong today, so a little bit of risk off. If you look at the US dollar, so it's really hitting the median part, right? And maybe I'll update this later on, but you'll see this like it'll go to the median or around this range part, and then that's where that's where the daily low will be, right? Our job is to identify, within like I guess the intraday trading system is to identify if the daily low or the daily high is formed, because the daily low and the daily high only forms one day at a time, right? There's only once a day, and based on that, you could actually use it to sort of execute your strategy as well. So, circling back to the currency. So, okay, so how would this strategy work? We talked about the tools. We talked about the heat map. We talked about the session theory, and we talked about the daily range theory, and so forth, right? So basically, what I like to do is, look at, you know, differentiate between two charts. One is a very noisy chart, right? So what's a noisy chart? You know, noisy chart is when you have like, let's look at a noisy chart. Uh, okay, I mean, you know, this could be a noisy chart. Why is it a noisy chart? Because you know it's basically a lot of zigzags happening, right? You see a lot of zigzags, you know, and then it stopped being a noisy chart, right? Uh, Another noisy chart would be, oh yeah, Euro CHF. Euro CHF is a noisy chart, right? So when you see a lot of zigzags, I think let's look at Euro USD yesterday. I just want to, you know, like this is a very noisy chart. It's a lot of zigzags, a lot of fake. You know, it's very hard to trade. You know, there will be guys that come in and they'll say, okay, well, this point, you know, this price here is very important, and you know, it breaks lower and so forth. But for me, when I see this, I'm like, this is very noisy. There's a lot of zigzags, you know, and you're gonna make a trade, and you're gonna sit there. The price is gonna reverse, and you know, you're gonna doubt yourself. Oh, did I make a wrong decision? And the price goes down again, and you're like, okay, that's the right decision. And the price reverses again, and you say, oh man, like you know, did I make a wrong decision? Is my trade going to be like, you know, thing, right? And then it'll go down again. So that what ends up doing is, you know, it becomes a noisy chart, right? Um, so when you do, you know, that's why I say, you know, just look at all the, you know, and look at an asset class, look at the currency pair, right? So find a chart that is less noisy, and based on that, like you know, look at this chart. This chart is very noisy, right? So if you're a US, you know, CHF JPY, somebody only who focuses on CHF JPY, this is really noisy. Do you want to trade something like this? You know, do you want to sit there and you know, sit there and try to figure out where the reversal is going to happen, right? And I will tell you this one time and time again is that the best and the easiest strategy to follow is a trend following, right? You don't have to guess where the reversal is going to happen. You don't have to guess anything like that to happen, right? So, like for example, like this one. Look at the heat map. US dollar is strong. Euro is still positive. So I have this is the strongest. The CAD is a little bit weird. I'm not going to touch the CAD. So CHF is the strongest right now, right? So if I were to look at this has been throughout the day. So if I were to pull something like this and I say, well, you know, Australian dollar and the CHF, Australian dollar and New Zealand dollar is positively correlated. So right now it seems that the New Zealand dollar is better than Australian dollar, right? So you look at Australian dollar and you say Australian dollar versus CHF. So you look at Australian dollar versus CHF and you see this, right? Um, you see this nice trend over here coming down, right? So basically what happened is you have three sessions. You have Asia session, and obviously CHF is not the best instrument to be trading in Asia session, right? You know, Australian dollar, New Zealand dollar, US dollar, and maybe and Japanese yen. Japanese yen is the best, one of the most volatile currency pairs. You know, it's 24 hours because, like I was saying earlier, is that Japanese yen is considered to be a funding currency. That's why it's more, has a higher liquidity in terms of CHF, right? So CHF is something that you trade in the in the European session. So if I were to look at this and I say, okay, well, you know, the European market opened, and you know, we look at what we call as a swing high and a swing low formation. So I was mentioning yesterday that we did quite a bit of work on algorithmic trading in Python, hooked up to MetaTrader 5, and one of the things that we looked at was price formation, swing price formation. So you see here, you take it 5 bars, and you see here, you know, the last uh, last two bars are red in candle, like full bodied red in candle, and then you have the the final candle or the candle before that, which is much lower than the candle right before the swing high, right? So that is a good indication that there is like sort of a bearish, or there is like a shift in momentum, or you can call it an inflection point or whatever it is. At the end of the day, it's just trading really comes down to making a bet, right? So you see here, right over here, there's another one here, right? There's another one here. I mean, obviously, right now it's easy to say because I know the price has already gone down. But again, you position size, you manage your risk, and you just make a bet. So that's what happened. So you see here, now the US dollar is staying. Let's see, currency market, the markets are open. Let's just do a quick thing. It's like the equity market is moving, just the opening right now. And the thing about equity market is from 9:30 to 10, about half an hour in the beginning, it really moves. The future trading guys must really love this price action because they're probably trading in 1 minute and making bets, right? So, okay, let's go back to our charting. We were looking at the Australian dollar and CHF. So, the point being that we identified which one is the strongest and which one is the weakest, and so forth, and then you basically sort of use that information to trade. Okay, so I'm just going to take a quick 30-second break, and I'm going to be right back. Okay, I'm back. These these live sessions are a little bit different than recorded sessions, because with recorded sessions, you can go back, you can do a lot of editing and this and that, but with live, you just gotta go with the flow. So anyways, we were looking at that. So let's look at New Zealand dollar. So Australian dollar was pretty poor, and then you look at something like New Zealand dollar and the US dollar, right? Let's see if the chart is clean. The chart is pretty clean. You have Asia that took it over here. I mean, I always tend to find that there's an inflection point, right? So there was a big sell-off over here, and there's an inflection point, sort of like a flag. This is what you call a bull flag, right? Sorry, this is a bear flag. So the price came down, it kind of reversed a little bit. There's a little bit of a bear flag, and then it went down again, right? So again, you look at this point over here, very simple terms, right? Not a lot of like trying to look at all the way to the back, and trying to map where, or trying to pinpoint where the price is. Very simple. Keep it simple, keep it nice. Look at the charts, look at tradable charts. That's very important. Tradable charts. So I look at New Zealand dollar, and I see here it's starting to hit the Q1. So is it gonna hit a median? I mean, at points like this, it's like really you got to ask yourself, right? This is where decision making comes in when you're doing trading. It's like, okay, am I going to chase this market? Am I going to chase? Am I going to go? Am I going to do a sell? Right? Most likely not, because like I said, it's starting to hit your. It's starting to hit your daily average range. So if you want to sell this market, probably right around here. Or even if you look at this, right? You look at this, and you say, where were the tradable points? Where were the tradable points? The tradable points were right over here, right? So you say, okay, well, this looks like it's really hitting. This is what you call a pennant. It's called a bullish pennant, right? I know people don't do this anymore. But this is called a pennant, right? There's really a downward pressure here. And then you say, well, if I were to make a trade here, like it's okay to do, like, you make a trade right here, and you say, Well, I'm gonna put this in, like, the last bar, the stop loss in the last bar, right? So when it comes to our application, it's easy to do because you're just basically even if so basically it just this what our application does is, it shows you the current bar where you would take the trade. But if I were to say, okay, I want to do a reversal and I want to do a buy, I think it's really hitting that thing, and maybe there's, I will take this as an indication, this price as an indication, right? You see here, there's a little bit of green, and really trying price really trying to, like, move higher up, and I will take that as an indication that maybe there's a reversal coming in, right? And I want to make a reversal and I want to do a buy, and obviously you do. With the thing about our application is that you can really trade from the chart. You can pinpoint where you want to place your stop loss, and based on your stop loss is what drives your take profit right over here. So there we go. Then you have 1 to 5. If you want to add a stop loss, there you go. You have one thing. We're also trying to update this trailing stop loss, because right now the trailing stop loss is based on the pip. So we're trying to change that into, say, your RR. So basically, if you want to, the best way to really, let the trade run is, you have 1 to 5, 1 to 7, or whatever it is. You use these markers to make your trade, 1 to 7. And you say, well, I want to put a 2 value here. This is in development. We're gonna, try to push this out soon. So what this does is, like, basically every time, you hit 5, then, the stop loss gets automatically moved on to 3. If you hit 7, then, your stop loss will automatically move on to 5. So that way you can sort of, like, let the trades run and also move your stop loss as it goes, right? So I'm trying to stick to a little bit of structure here, but it's kind of, hard to get off track. So okay, so we were looking at that. We were talking about the charts, noisy charts versus clean charts. We talked about, London session, which I considered, I was talking about, sometimes you'll see a price moving to a particular, direction, right? You'll see price moving to a particular direction, and, you come in around 12 to basically right up to when London opens. You'll see, and you can do this. You practice. I always say practice. Look at the charts. Develop your charting skills, and you'll see this. This is called a bull flag, right? It's the opposite of a bear flag. That's what it is. And you'll see this, and this has been on a serious uptrend because U.S. dollar has been on an uptrend for thing. And then now the New York session is opening, and you see something like this, right? We talked about the swing position, like swing formation, and hopefully in the near future, we can add an indicator where it identifies points like this. If you're ITC guys, you'll say POI, right? Point of interest. Okay. So you see this, and then you say, well, okay, then kind of makes it looks like the price is reversing. Let's look at our thing, and then yeah, it looks like it kind of got to our daily range, median Q1, Q2, Q3, and then it started reversing. That doesn't mean so. That's what it is. So it looks like the New York session opened, and the US dollar is losing a little bit of momentum now. If I were to look at this value, I think that it has peaked, right? If I were to look at USD CHF, yes, it was 46% high, and now it's coming back to 14. The lowest is this one. So I'm off my daily high. Now, this is how you read the chart, all right? But USD JPY is still strong. So if I go here and here, see, this is what I mean. So it's still strong, it's still trading on the highs of the day. I don't need to look at the charts. I can just look at this and basically say, okay, well, USD AUD looks like it is still highs of the day. It's trending at the highs of the day, right? So that's something that allows me to do this heat map allows me to do even without letting the chart. Obviously, you have eight. Sorry, over here you have eight instruments, and you have seven currency cross currency pairs that ends up becoming 28. So it's kind of hard. I mean, maybe this is one of the reasons why people say, only focus on one currency pair. It's 28, so just focus on one. No, it's okay. You have to develop tools to sort of make your screening process a little bit better, right? So if I look at this and I say, okay, well, Australian dollar is still trading on its USD lows. So here we are. If I were to pull this up, and this is what it is, right? So obviously, if you were to use correlation, then you would say Australian CHF is, Australian dollar CHF is probably going to be lowest. So look at this, right? So you see here, our Australian US dollar is hitting its all-time low. So if I were to go here and I say, okay, well, let's look at this. AUD CHF, there we go. It's really banging on the low part. So, I think going forward every day, I will look at the markets. I understand this, how to trade the markets. I mean, not how to trade the markets, but what to look out for. Noisy charts, clean charts, daily trends. Most of the times, you'll have like, why is the CHF so strong today? Well, CHF is actually not so strong. It's the US dollar that's strong. But if I were to look at US CHF and Euro, then I would say, okay, well, the CHF is stronger. Why is CHF stronger? Uh, Fundamentally, I don't know much. I mean, I follow Swiss SNB, Swiss National Bank's news clippings or news, sound bites of news here and there, but not more than that. I don't really follow the Swiss economy too closely, not as much as I do with Canadian or Europe or USD or the US or something, because US is basically the world's biggest economy, and that's the main driver of the global economy, right? Okay, so I'm gonna wrap it up in 5 minutes. I talked about the session, so one of the things you can actually do is, again, right, look at your charts, try to identify markets that are moving, tradable markets, like like this market right here, Canadian JPY. This is barely doing anything at all. This is such a hard market to trade. It's just basically stuck in a range. Okay, I'm gonna do quickly a couple of things that I forgot I wanted to cover was the Australian US dollar, right? Sorry, Euro odd. Euro odd tends to be like risk on, risk off as well, because euro is considered to be safer than Australian dollar. So I remember uh, when 2017, I think, or 2018. Oh yeah, when Donald Trump started the trade war with China, and what's her name? The Huawei's daughter got arrested here in Vancouver, BC, and Australian dollar were just off the roof, right? So we're just rallying really, really hard. So if I were to look at the Australian dollar, I know the euro has been trending up the whole day, at some point thing. And then I see around like 10 o'clock, Asia session, it went up and it came back down again. Obviously, I don't know if this chart is going to be noisy at all or not, right? I don't know that. But then you'll see something like this, swing points, right? Bouncing off the lows of the day, right? Bouncing off the lows of the day, you see this position right here, and you say, okay, well, this is a good tradable chart. The other point you can see is right over here, right? It broke the highs of the day. This is called a breakout strategy. So it, solidly it closed above the highs of the day. That tells me there is like a little bit of thing. I don't know how far it's going to go. Nobody can really say, right? But you manage your risk. And we didn't get into risk management, order management, and all that stuff, because basically we spend a lot of time talking about the execution strategy. This is the execution entry strategy. You have entry strategy, you have risk management strategy, You have order management strategy, and you have an exit strategy, right? And this is called a trading plan. You got to put it all together. People will say, "Oh, I entered, but I don't know when to get out." Okay. Um, so with the intraday trading system is basically what you do is you set a high, you set like a maximum a loss for the day, right? And you'll say, well, I'm going to set my maximum loss to 0.6%. So basically, what we do here is we measure the percentage in basis points. So you have 1% will have 100 basis points. So 25 basis points is basically 0.25%, right? So you're looking at, because if I were to do trades and let's see here, okay, well, this is a little bit of thing. I'm just gonna do a sample here. Okay, let's look at this. Okay, the Canadian dollar looks like it's getting strengthening a little bit, and I'm trying to guess that, okay, well, maybe there's a reversal trade here. It hit the mean, and it's going really towards the median average, and I'm gonna hit the thing. Okay, this is what my trade is gonna look like. I'm gonna trade this default thing. So my daily maximum loss is 60 basis points. That's basically 6.6, and you divide that into maybe a number of trades that you want to do, and you just hit a sell. There we go. So now, when you look at this, the other thing that really good is like it gives you an expected total profit and expected total loss, right? So now my maximum total loss is 0.1. My maximum profit is 28 basis points, the whole thing. So my maximum loss is 10 basis point. My maximum profit is 28 basis points. So as you stack your trades, this is very important, is to be able to see what your maximum loss and your maximum profit is going to be. Right, this is very important. And the reason why it is important is because a lot of people will just do averaging trades. They will stack 4 or 5 trades within the same direction in the same instrument pair, right? And then you're just flying blind, because in your head you don't know what your maximum profit is going to be. Even though you have a stop loss, you don't know what your maximum loss is going to be, right? And when you don't know that, it causes anxiety. It causes fear. And say for example, it does get into your maximum loss area. This trades reverse. We don't know. And then what ends up becoming is that you're thinking, oh, then you start developing what do you call it? Revenge trading, right? Because you didn't know in your head that your maximum loss is going to be whatever, 1%, 2%. We just basically do some small percentage here. And obviously, if you're going to over leverage yourself and you're going to hit like that risk pedal really hard, then it can be like 50%, or it can be 20% or 10%. You have 10 positions running and you don't know where your maximum loss is going to be, and suddenly you're faced with your maximum loss and it's 25%, and you're like, oh my god, this is 25%. Now I have to do something to come back. Right? That's basically called a revenge trading, right? So when you have in your head, when you have mentally, you're prepared for a maximum loss, it's a lot easier to deal with that. That's the whole point. Okay? So, I'm going to come wrap it up for the day. Maybe we'll come back tomorrow again. We'll talk about more of these concepts, and we'll develop that. We will work on the strategy and how to identify noisy charts, how to use the time session theory, or the range session theory, or what's moving the market, what is the market focused on. So we'll work on a lot of that stuff. In your part, you can, if you want to execute this strategy, then you can, think about looking at the charts. How do I simplify my trading? How do I use simple methods to execute a simple strategy, right? And you'll hear this over and over again. Keep your strategy simple. Make it simple enough that you look at these variables and what you need to trade, right? So that your decision-making process is a lot easier. If you have excuse me. If you have, I guess I've been talking for a long time. Um, so if you have like a lot of variables running, you're looking drawing a lot of lines, and you're saying, okay, well, how are these lines affecting all that stuff? So you have a lot of input variable and stuff. So what that happens is like it messes up with your the clarity in decision making process, right? So that's what we do here. Try to keep it simple. Try to use this intraday strategy. You hit your, you set your daily loss, you set your daily profit, and then you just, say for example, like, if I were to set this, take profit one, set it to 23 points, and if it gets there, that I break even, and then walk out, right? Uh, so point being is that you set your maximum loss. You say, oh, I'm going to set my maximum loss to zero point 0.6. You hit your maximum loss and you take a step back. Don't trade for the rest of the day. Do something else. Clear your head. Go out, so you don't get into a rabbit hole, right? That rabbit hole, I've been there many, many, many times, is where you're constantly going to look at your phone. You're constantly going to be checking. You're trading in a 4-hour chart. You made like 5 trades, but you're looking at 1-minute chart and you're following each and every tick movement of that price, and causes a lot of anxiety, right? You don't want to be, point is, you don't want to put yourself in that position. You definitely don't want to do that. And that really stems from the fact that you don't have a clear picture on your limits of your maximum loss, your maximum profit. If you're very, very clear on that, and you can step back, and you hit your maximum loss today, take a step back, tomorrow you come back, because the charts are not going to go anywhere. The market is not going anywhere, right? Don't force yourself into a corner where you're making a trade. You want to make you hit like you hit yourself say for example, you set yourself a maximum zero point 0.6 or 60 basis points, and you hit your daily loss, and you say, oh my god, I gotta make it back because the markets are there. Chances are maybe you'll make it back. Maybe do one trade and you'll do one trade, and that trade will basically cover thing. Maybe you'll want to hit the over leverage. You will hit like an over leveraged position, and maybe that position will work out, and maybe you'll make 1%, and overall you are like up 40 basis points, which is zero point 0.4. But what are the chances? Why take that chance? Why put yourself in a position where you either make yourself you're putting yourself in a position where you're going to increase your losses? Why put yourself into that position? Fine, the reward is there. The reward is that maybe you'll make a comeback and cover your losses, and then you'll be profitable. But the point is that you're putting yourself in a position where your losses can get bigger and bigger and bigger. And also ask yourself, like, and also ask yourself, are you in the right mental state to be trading? Are you trading out of fear? Right? That's something you definitely don't want to do, is that you don't want to trade out of fear. I mean, I say this out of my experience. I've been there. And why am I doing this? Is because I'm trying to create something that's more structured, right? Something that's more structured is going to help me say, well, okay, I know what these numbers are going to look like. My worst case scenario, my number is going to look like this. My best case scenario, my number is going to look like this. So we don't know what the outcome is going to be, but at least mentally, you're prepared for that. Okay, so we're a little over time. I'm going to wrap it up. Good luck to you guys, and we'll catch up tomorrow morning. Maybe around 8:45 is when we will start our thing. We'll do something similar. We'll look at the markets, and all that's forth. I mean, obviously, I can't really, trade with you guys, because, here I am trying to explain a system and all that stuff. And, you'll see, well, okay, this is a little bit different because, I'm more used to somebody on, like, Telegram or Discord trading live with me. Yeah, of course, if I'm sitting here for 5 hours and looking at charts, then obviously, I can do that. But within a 1 hour time frame, let's see. Like, this is the trade I'm taking. I'm just gonna let it go. Let it go. Maybe it'll work out, right? So basically, what am I looking at? I mean, this is a little bit different because I think my stop. What I did was, I put my stop loss in the swing high. Maybe I could have done this, right? So okay, here, let's. This is risk management. I'm not gonna get into it right now. But look at this, right? This is order management. I put myself in a position. The bar looks like it's red, and I'm gonna update this thing. Now, guess what? My expected loss is 0.5, right? It's okay if it hits it, but I minimize my risk. So stuff like that, risk management, order management, active trade management. We'll get into that at some point, maybe tomorrow, day after, or so forth. Okay. All right. Good luck to you guys, and I hope this session was much better than the last two sessions. Obviously, there's a lot of technical difficulties that I was dealing with. I was also not feeling too well. Came down with the flu, and all that kind of stuff. Okay, guys, have a good one.